A sovereign debt crisis is sweeping Europe, and as the dominoes fall, many experts say the United States is in danger. Huge deficits and runaway spending may lead to a jump in interest rates and a downgrade of U.S. debt. But the ratings agencies are behind the curve. Are they relevant? And what should you do to protect yourself? Here is David Goodnow.
We are facing one of the most dramatic changes in Wall Street history, the downfall of the leading rating agencies. Of course, no one can predict the future, but there's one thing we can say with certainty. When a company is downgraded, its stock and bond prices almost always fall. So the big question that now confronts us is this: what happens when the rating system, covering trillions of dollars in securities, is itself downgraded? What happens when everyone realizes that the ratings issued by Moody's, S&P, and Fitch are themselves worth less than we thought? Does that mean that every corporate bond, municipal bond, and even government bond that they rate is in effect downgraded? Here to answer that question is Weiss Ratings founder and president, Martin D. Weiss.
Thank you, David. You know, our business model is totally different from that of other rating agencies. Weiss Ratings is one of the very few that accepts no compensation whatsoever from the companies it rates. We cover the nation's banks and insurance companies. We also distribute independent ratings on thousands of stocks, ETFs, and mutual funds.
According to the U.S. Government Accountability Office, the GAO, Weiss was first in warning of future failures among insurance companies, beating Moody's, S&P, and AM Best. According to Barron's, Weiss Ratings is the leader in identifying vulnerable companies. And according to a report of the Wall Street Journal, Weiss stock ratings beat every Wall Street firm and every independent research organization they covered.
Thanks. And so, fast forwarding to here and now, I'd like this program to be a good place for you to come to get our unbiased independent ratings for free. The good, the bad, and the ugly.
But first, Martin, let's get to the answer of the fundamental question I asked at the outset. What do you think will happen when the established rating agencies themselves are downgraded? Plus, tell us exactly how you beat your competitors.
Well, let me start with the second question. We're not smarter than our competitors, nor do we have better access to data than they do. The real difference boils down to one single four-letter word: bias. Their ratings are biased because they're bought and paid for by the companies they rate. Our ratings are independent and objective because we don't accept a dime from the companies we rate. We're free to upgrade and downgrade based exclusively on the facts. We're here to protect investors and consumers, not the companies.
Martin, but what's going to be the outcome of this ratings debacle? How's it going to affect investors?
Well, unless the rating agencies abandon their conflicted business model, extreme doubts about the credit ratings will continue to spread. Investors will scramble to reassess the risk in trillions of dollars of rated securities they own. Then those investors will decide independently what the true ratings should be, effectively issuing their own downgrades on thousands of securities.
And then?
And then they will sell, because almost invariably these companies are overrated. Only very rarely are they underrated.
We remember Enron, and of course we remember what happened in the debt crisis with Bear Stearns, Lehman Brothers, Washington Mutual. In each case, the rating agencies failed to warn us, even gave these failed institutions top grades to the very day they failed. So, what in your view is going to be their next major failure?
Well, S&P and Fitch have so far been extremely hesitant to downgrade the long-term debt of three major nations that are mired in the deepest fiscal mess of all time. Those nations are the United Kingdom, Japan, and the United States. Now, to downgrade these countries a notch or two would not be unpatriotic, nor would it mean that these countries are going to default. All they'd be doing is recognizing the fiscal follies that are already in place.
And doing the job of warning investors of the increased risks.
Yes, yes.
Thank you, Martin. In a moment, we're going to talk about how this will impact interest rates and the implications for those investors. From our studios in Jupiter, Florida, Weiss Money Network presents Money and Markets. And now, Jamie Holmes.
The U.S. economy seems to be on the slow road to recovery after the worst financial crisis since the Great Depression, and the Federal Reserve has kept interest rates at historic lows to encourage that recovery. But, as we can see from the sovereign debt crisis sweeping Europe, the global economy is still in big trouble, and the U.S. may not be the safe haven that investors think it is. Could the U.S. experience the same kind of bond market collapse and explosion of interest rates that Greece has seen? And what would that mean for consumers and investors? Mike Larson has been warning about just such a crisis. He joins us now. Mike, what are you seeing that tells you we're headed for a spike in interest rates?
Well, Jamie, first of all, interest rates drive the entire economy, from hiring to consumer spending. So this isn't just something for investors to worry about, it's something we all need to pay attention to. And I'm seeing several major warning signs that tell me we're already on the path toward a bond market crash and a spike in interest rates. Now, granted, it's a long and winding road, so the crash may not happen for a while, but if one major factor doesn't change, it's inevitable. And that factor is simple. The federal deficit is absolutely out of control.
Well, that's no surprise. Politicians on both sides of the aisle have been warning about that for years now.
Well, that's true, but talk is cheap, and meanwhile, the deficit's just getting worse. Last year, the budget deficit was $1.4 trillion. Now, that's nearly 10% of gross domestic product. But this year, President Obama's budget outlook predicts that figure is going to rise to 10.6%. Now, just to give you some context for those numbers, at the height of the Great Depression in 1936, the deficit topped out at less than 5%, and we're already at more than double that rate.
Okay, so obviously the bigger the deficit, the more debt the government has to issue to pay for all that spending.
Well, exactly, and that's the second major warning sign I'm seeing. The supply of treasuries is exploding. The U.S. government is now auctioning more than $120 billion in debt every week. I mean, take a look at this chart here. You can see that the supply of 5-year treasuries was around $13 billion per month just a couple years ago. Now it's way up at $42 billion, and we're seeing similar jumps all the way across the treasury curve. Worse, this trend isn't slowing down anytime soon. The total U.S. debt load is on track to double over the next decade to $18.6 trillion.
Okay, some people might ask, what's the problem with issuing so much debt if people are still willing to buy it?
Well, it's fine until they stop buying it, and there's no guarantee that the U.S. bond market is going to remain that safe haven it's always been. In fact, I think we can learn a major lesson from what's happening in Greece and other European countries. One of the big problems in Greece was that the amount of its debt was higher than its gross domestic product. So its debt to GDP ratio before the economy collapsed was about 125%. Then you have Portugal, which is on the brink of insolvency itself. It has a debt to GDP ratio of just above 85%. But look at the US, nearly 95%. Or in other words, our debt makes up a higher percentage of GDP than Portugal's. That can't be good.
So if we're in the same type of trouble as Greece and Portugal, why are investors still flooding into U.S. bond markets?
Great question. I like to think of the global bond market as a ship. Right now, the ship is beginning to sink. We can see that happening in Europe. But if you remember what happened with the Titanic, as the ship began to go down, the stern actually rose up out of the water. And that's what's happening with the U.S. bond and currency markets. Right now, investors perceive them to be places of relative safety. They're rising up as Europe plunges. But just like with the Titanic, eventually the entire ship will sink. And we're already seeing the first sign of this. Look at the recent decline in the U.S. stock market. You can see that stock investors are beginning to realize that the country's problems are just too big to fix by spending and printing money.
So if your predictions do come to pass, where do you see Treasury yields going?
Well, let's use the 10-year Treasury note as an example. Right now, its yield is still below about 3.2%. But my intermediate term target is up here around 5.5%. And I think there's an outside chance of it hitting its 2000 high up at 6.8%. And the same goes for long-term corporate bonds, long-term municipal bonds, and long-term junk bonds. Rising interest rates are going to affect them just as much as they are going to affect Treasury securities. Now again, we want to keep in mind I'm not predicting this is going to happen immediately. There's no way of saying exactly when the bond market will crack. But investors have to know that there are major risks in that market, even in U.S. Treasuries, and they have to protect themselves.
Okay, Mike Larson, thanks so much for being here.
Thank you.
So speculators have a real opportunity here to profit from a downturn in the bond market. But let's get real here, folks. In such a dire situation, most investors would be happy just to protect themselves. So how can you preserve the value of your portfolio when some of your safest assets are tumbling? We're joined now by Nilus Mattive. He is from the biggest little state in the Union, Delaware. He's got some answers for us. Hello, Nilus.
Hey, Jamie. How you doing?
Oh, hanging tough. What do you got for us?
Well, the first thing I want to say